Hi, this is Mike Maloney. In an article that I was reading recently, somebody pointed out that there has been a very, very reliable technical indicator for market crashes, at least for this century. This is a chart of the S&P 500, which is the 500 largest companies in the United States. So it's a very good measurement of the stock market, proxy for the entire stock market. And then there's a 50-week moving average and a 100-week moving average. For anybody that doesn't know what a moving average is, you simply take the past 100 weeks of the points on the S&P, add them all together and divide them by 100, and then plot a dot on this line, and then the next week you do the same thing, and the next week you do the same thing. The same goes for the 50-week moving average. But what you see here is when the 50-week moving average crosses over the 100-week moving average to the downside, there's a crash that follows. It crosses over, and there's a crash that follows. And we're crossing over again right now. So this has been an extremely reliable indicator, like I said, and I've been presenting evidence that the economic expansion is exhausting itself and that the stock market is probably going to be rolling over and going down. I've been presenting this evidence since late 2014, early 2015. So just as it approached this top here. And what I see here is there's more evidence. This is the 4-week moving average of initial jobless claims. The reason we use a 4-week or a 1-month moving average is because the data week to week varies so much that it's basically dots all over this chart. But what you see here is unemployment insurance started back in the 1960s with Johnson's Great Society, and so that's this big leap up. And then it was at about 200,000, and it rose to where the bottoms of, every time we would have a recovery, and the number of filings would go down and down and down, it would bottom somewhere around 300,000. Well, today we're at 258,000, and that is the lowest level since the 70s. However, this is just the absolute number of initial claims. If you divide that by the population, this is actually the lowest that it's been. Back in the 60s, the population of the United States was about 180 million people. Now it's 330 million people. So I can't create a chart on here and divide it because the data only goes to the end of last year when it comes to the U.S. population. They come out with a new statistic each year, so it won't include these very low numbers that we get in 2015 on the initial jobless claims. But what I want to point out here, I got this from another article that I was reading, is that every time it hits a very low level like this, it jumps up suddenly when a recession starts. So these low levels are actually a predictor of the end of an economic expansion, not the beginning of one. Now, the Federal Reserve trumpets their success, how well they've done. This is one of the measurements that they use. They say, see, there's very, very low initial jobless claims, so we've done a great job. The future is bright. Well, the future isn't bright when the jobless claims are low. The outlook for the future is that a recession is very, very likely. So here we are at these very low levels, meaning a recession should be just around the corner. And if you take a look at the net savings rate, this I find, I love these charts that go back and give you historic context. This chart goes all the way back to 1929. But what you see here is that with the Great Depression, people started spending their savings. So savings went negative when they had no income, they had to spend it. And then once anxiety levels became very high, 1941 is World War II, started December 7th of 41. So this peaks in 42, right with the beginning of World War II. Again, it started December 7th, which is the very end of 1941. So this peaks at 16% of everybody's income was being saved for the future. And if you look at the 40s, 50s, and 60s, it averaged about 10%, maybe a little bit more. And then it started descending in the 70s, and the 80s and 90s, it averaged around 5%. But this century, it's averaging around 2.5%. And again, it went negative after the crash of '08, which the only other time in history was the Great Depression. And we've made this very, very weak recovery here, which suggests that with the next downturn, people don't have anything saved to spend to keep themselves from being out on the street, from really having some very high economic hardship. And then this graph I've presented many, many times. It's the value of the stock market compared to the growth of base currency, how many paper dollars exist. And if you take this back further, you see absolutely no correlation between growth of base currency and the stock market other than they both rise. But with the crisis of the 2008 global financial crisis and then the initial bailouts and all of the quantitative easings, the currency printing, the correlation between these things, as I've said many times, there is no possibility that this is just coincidence. The creation of base currency has levitated the stock markets. And what you see here is that when Janet Yellen tapered at the end of 2014 and the growth of base currency stopped, for a little while the stock market continued its way up, but then it crashed right down to base currency. It did it again, and now we're elevated off of base currency quite a bit one more time. And going back to the S&P 500 here, one of the things that looks pretty bad is that there's this area right here where there's lower highs and lower lows, and that is a bad sign. That is the definition of a bear market. Now we've got the moving averages are just about to cross over to the downside, the 50 and 100 week moving average, and that is a very, very negative sign. And what I see here, this year and a half or so of the stock market rolling over and descending, I don't see a pattern like that in the last 20 years. There's nothing like that here. And so I think we're in for a wild ride. This should be very bad for everybody except precious metals investors. Whenever there's turmoil and whenever there's a lot of anxiety, precious metals are a crisis hedge, not an inflation hedge. And so when things get bad, people move towards safe haven investments. I would expect bonds to do well, and I would expect precious metals to do well. And those are about the only things that I think will do well during this next economic crisis that's about to hit us, I believe. And so if you found any of this enlightening, please like and share this video. Thank you very much for listening. This video was brought to you by goldsilver.com. I'm proud to say we've been one of the most trusted dealers for over a decade now. We have fast, free shipping and a price match guarantee. While our competitors serve you ads, we serve you education. And that's the difference with goldsilver.com. To learn more, click the info button. Thanks.